everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your tutor and your mentor. Today, we are going to look at the Consolidated Statement of Financial Position. We have covered some key aspects in the previous lecture. So today, we are going to look at more complex areas that is very important for the understanding of the Consolidated Statement of Financial Position. So basically, we are going to look at the consolidated SFP, and we are going to look at the working, the 5 steps that you need to know before you are going to prepare the consolidated financial statements. Basically, we are going to look at the group structure, and we are going to look at how to calculate the net assets of the subsidiary, looking at acquisition date, at reporting date, and we are going to look at post acquisition changes between the acquisition date and the reporting date. Then also we are going to look at the pre-acquisition profit and the group reserves, how we can navigate and how we can distribute profit between the NCI and that of the retained earning, the parent, depending on whether the fair value model or the evaluation model, or whether we are going to use the proportionate model. So basically, we have lots to cover under this session. Then also we are going to look at the non-controlling interest. What is the meaning of NTI? And we are going to look at some inter-group trading, goodwill, mid-year acquisition, and also how we can account for the unrealized profit if we are talking about the inter-group transaction between the parent and the subsidiary. And also, it's very important concept under the goodwill, whether we are going to use the fair value model or not. So basically, throughout the session, we are going to cover these very important areas. So now we are going to look at the definition of consolidation. I mentioned it in the previous lecture. It's basically the process of putting together the financial statement of the parent company and the financial statement of the subsidiary, put it as a single economic entity. That's what we refer to as the consolidated financial statement, according to IFRS 10, because the parent company, by legal, it's individual company by its own in legal substance, while the subsidiary in legal is a single company. But for the sake of consolidated and for the sake of the existence of control by the parents to the investee, then IFRS 10 gives us the right to put together both financial statements of the parent and the financial statement of the subsidiary together to produce a single entity financial statement, which we can use to make a strategic financial decision in terms of the single entity. I'm not talking about in terms of the individual um, financial statement of the parent and that of the subsidiary, but we are talking about the consolidated, the financial statement that we are going to put together. So now, basically, the basic principle of the consolidation is for us to show all assets and liabilities of the parent company and the subsidiary. Be very curious about this. This is the basic principle. Everything that we are going to do throughout the session of consolidation is to achieve this objective. The basic principle is this: all assets and liabilities of the parent and the subsidiaries should be consolidated, should be put together. We need to combine all the assets and liabilities of the parent and the subsidiary. Alternatively, if there's any intergroup transaction between the parent and the subsidiary, for example, the parent company sold goods to the subsidiary. Now, we are going to look at it in detail in the later section, but for now, for any intergroup transaction, for example, the receivable, because if the parent sold goods to the subsidiary, then the subsidiary can be recognize a payables, whilst the parent will recognize a receivables, because the subsidiary will have to pay the parent. So basically, because of this, the receivables and the payable balance, we are going to ensure that we exclude them in the preparation of the financial statements. For the consolidation, also we are only going to include amount that is outstanding from other party other than the parent and the subsidiary. Very important concept. So basically, these 2 points is very important for you to understand the whole content of the consolidated financial statements. Firstly, you need to know we are going to put together all the assets and liabilities of the parents and the subsidiaries. Secondly, any intergroup transaction. When I am talking about intergroup transaction, it means transaction exclusively between the parent and the subsidiary should not be included. For example, receivables and payables within the parent and the subsidiary should not be included. However, any transaction that is not within the group transaction within the parent and the subsidiary should be accounted for as normal course of business transaction. This is the basic principle of consolidation. Everything that we are going to do, our 5 steps to prepare the consolidation will be based on this fundamental principle. So now, the key concepts I've already explained in our previous session about parents, about subsidiary, and also the situation where there's an existence of control, nothing to worry about. So basically, you're going to look at how in real time, how we can prepare the consolidated financial statement on a line by line basis. So now the basic format you need to have back of your mind from the basic principle. Firstly, for the assets of the parent and subsidiary, we are going to add them on line by line basis. We are going to add the assets of the parent and the assets of the subsidiary on line by line basis. First thing that you need to know, that you need to have back of your mind. The second point, all liabilities of the parent and the subsidiary should be added together on line by line basis. For example, under the liability, we have the non-current liability of the parent and non-current liability of the subsidiary. We need to add them together. If we have the payables, we need to add them together. Whichever liabilities that we are going to talk about, then we need to add this liability of both the parent and the subsidiary. Now, the technical bit is how we can account for some components of equity. This is a little bit technical, and this is the point that you need to know how we can account for certain components of equity. For example, the share capital. We can only take the share capital of the parent company. We can't add the share capital of the parent and the subsidiary. It is not allowable because why? And in later chapter, we are going to understand that why are we not going to add the share capital of the subsidiary? It is because, which is very clear and simple, when we are going to calculate the goodwill and when we are going to calculate our net asset, we are going to use the excess of the consideration for the goodwill over the net assets at the date of acquisition. So because of that component of calculation and that component of understanding, we are not going to add, and it will make no sense to add the share capital of the parent and the subsidiary. So share capital, whenever it is given in the question, you should know that we just need to take the share capital of the parent. We should not add both together. First point. Now, when we are talking about the retained earning, we are going to do a separate working for the retained earning, which can be working 4, working 5. So basically, the group retained earning, it's a different component which comprise of the profit earned by the group, which we can look at separately. Then also we are going to look at any share of post-acquisition profit. We are going to look at it separately, don't worry. For now, what you need to know, for retained earning, we are going to include the group profits of the retained earning, then also any post-acquisition profits, we are going to include it. So basically, when we are going to do our net asset working, we are going to look at it separately. And when we are going to do the retained earning working, we are going to look at it separately. And finally, for the non-controlling interest, we are going to use the working also to ascertain the value of the NCI that we are going to show in this consolidated statement of financial position. So this is the basic preliminary formula that you need to know. So basically, this is the method. For a single subsidiary, in a situation where we only have one subsidiary, the investment in subsidiary shown in the parent statement of financial position is replaced by the net asset, as I already mentioned. Because when we are going to look at the parent financial statement, we can see investment in subsidiary. In the individual parent financial statement is what I'm talking about. We can see a figure which is the investment in S because we are going to show it in the financial statement of the parent company that we have invested in this subsidiary. So we need to show it in the individual financial statement. But when we are going to prepare the consolidated financial statement, we are not going to show that amount again. Instead, it will be replaced by the net assets of the subsidiary, which we are going to calculate in working two. This will be the replacement of the investment in subsidiary. Instead of showing investment in subsidiary, we are going to calculate the net assets, which we can use in different areas to do further calculation. Also, the cost of investment in S is effectively cancelled against the ordinary share capital and the reserve. As I already mentioned earlier, the cost of investment in S will be cancelled. We are not going to look at it when we are going to prepare the consolidated financial statement. And also, by looking at the cost of investment and compare it with the net assets of the subsidiary at acquisition, it will give us what we refer to as a goodwill. So basically, the concept of goodwill is telling us that we are going to look at our investment in the subsidiary and looking at the brand name the subsidiaries has developed, or looking at the good reputation, or looking at the royalty, whichever type of goodwill that we as a parent company is going to benefit from the investment in subsidiary. So that benefit will arise as a result of the difference between the cost of investment, the amount that we are going to pay for investment in subsidiary as compared to the net asset of the subsidiary. Then if the investment cost is more than the net asset of the subsidiary, it means we have paid excess amount for the acquisition of the subsidiary, which is the goodwill, is what we are talking about. So instead of showing the cost of investment, we are going to look at the components of goodwill, is what we are going to show in the consolidated um, financial statement. So basically, this is what you need to know. This is the basic step again. All assets and liabilities of the parent coming in add together. Share capital, we can only take the share capital of the parent. For the retained earning, we are going to look at the comprise of the profit, and then also we are going to look at the post shares, the post acquisition profit shares. So now basically, um, let's try to solve this question so we can able to understand better. Let's look at the concept of the consolidation. So now, just check. Okay. So basically, let's look at the preparation of this consolidation for just our understanding, right? Based on the basic concept, we need to add, let's say, console, right? We need to add all the assets and liabilities of the parent and the subsidiary. So we are going to add 60 plus 50 will give us 110, for example. Now, we are not going to consider the cost of investment based on the basic principle. Cost of investment, we don't have to compare anything. Then the current assets we are going to add 40 plus 40 will give us 80. So therefore, the answer will be 190. This is what we are going to. Therefore, also we are going to consider the ordinary share capital. Based on the basic concept, we are only going to consider the share capital of the parent, 100. Parent only. Parent only. We are not going to add the share capital of the parent and the subsidiary. No, because the subsidiary share capital will be replaced with the cost of investment when we are going to look at the goodwill, as well as when we are going to calculate our the net assets from working two. Then also, when we are talking about the retained earning, it has further aspects of the post sharing of the retained earning. So now let's look at the current liability. We are going to add 20 plus 40. All liabilities of the parent and subsidiary, we are going to add it. 20 plus 40 will give us 16. So now basically, for the retained earning for this purpose for now, because we just want to keep the concept so simple, we are only going to consider the retained earning of the parent. So we are going to use parent only because we are not going to calculate any post sharing of acquisition profit. So this will be 30. So for the sake of the concept, to understand the basic concept, this is how we are going to prepare the consolidated financial statement. Now, if you look at the notes, we have P acquired 100% of shares in S on 31st December 2024 at the cost of this. So basically, you know, the acquisition process is 100%. So there will be no NCI. So therefore, there will be no further calculation. So for now, let's keep it simple, right? Let's keep it very simple and precise because we have more complex area to look out for. So basically, this illustration is for us to understand the basic principle that we need to add all the assets and liabilities of the parents and the subsidiaries. We need to only consider the share capital of the parent only, and also the retained earning. We are going to look at the profit, and from the we are going to look at the post acquisition profit. Don't worry about it. We are going to look at it in detail. So now, um, key step that you need to know for the examination. Whenever you want to prepare the consolidated financial statement, these steps should be followed in a chronological manner. We need to follow this step because the preparation of the consolidated financial statement is a little bit not difficult, but it should be prepared in a chronological manner so you can get the maximum mark and understanding that is required. Now, the key concept you need to know: a standard group accounting financial reporting question will provide the financial statement of the parent and at least a single subsidiary, or it can be more than one subsidiary, and will require a company to produce or to prepare the financial statement, the consolidated financial statement. So basically, the best approach is for us to do the working in a chronological manner. Working one is talking about the establishment of the group structure. So we need to establish the group structure. We need to show the proportion of holding between the parent and the subsidiary. So we need to show the proportion of ownership or holding between the parent, the parent and the subsidiary. For example, if the parent own 80% of the share capital of the subsidiary, so it means the P will equals to 80%, whilst the subsidiary will equals to 20%. Or if the share capital or the voting right of the parent is 70%, then the subsidiary will be 30%. So basically, this is the group structure. You need to establish the group structure because in most cases, this will not be given in the question, so you need to find it. You can either use a proportion of the voting rights or the number of shares. So we have two approaches in which we can use to find the percentage of holding, the investment ratio. So for example, we can use the number of shares, number of shares, number of ordinary shares purchased. For example, let's assume um, company A, company A purchases 1 million ordinary shares from company B with 1,200 shares. So basically, from this question, we need to calculate the percentage of holding, which can be the 1,000 shares divided by 1,200 multiplied by 100 will give us the number of shares acquired, the ordinary shares. So this will be the proportion of investments that we can account for as the proportion of holding for the, the parent company. And the difference will be for the subsidiary. Let me do a calculation. So 1,000 divided by 1,200 will be 83%, for example, 83%. So therefore, the NCI, the subsidiary, will equals to um, minus 100 minus 83, 17%, for example. Or alternatively, we can also calculate the percentage of holding based on the voting right. For example, working um, two, the question might tell you that the parent company has um, 8 voting right out of 10 directors. So it means 8 divided by 10 multiplied by 100 will give us 80%. So these are the two ways that we can calculate the proportion, the group structure when we want to know the percentage of holding of the parent and the subsidiary. Either can be given in the examination, so you need to be mindful and you need to be aware of how to do this calculation. Nothing difficult, nothing to worry about. The step two has to do with the net asset of the subsidiary. We are talking about net asset of subsidiary. We're not talking about net asset of parents. We are looking at the net asset of the subsidiary in isolation. That is, we want to know at acquisition, when we are talking about acquisition, it means the date that we are going to purchase that particular subsidiary. What is the value? What is the value of the net asset at that date? Then also at the reporting date, the date that we are going to prepare the consolidated financial statement. Just imagine the net asset of the subsidiary is telling us that at the acquisition date, the date that we are going to purchase the subsidiary, the date that we are going to purchase the subsidiary, purchase or invest in subsidiary. That date or that date that we are going to invest, we are going to look at all the net asset of the subsidiary. Then also at the reporting date, the date that we are going to prepare the consolidated financial statement, that date that we are going to prepare the consolidated financial statement, which is at the reporting date, we want to know what is the net asset of that same subsidiary, not the parent. I'm talking about the subsidiary. Look at the statement, net asset of subsidiary. So we want to know at the reporting date, what is the value of that net asset of the subsidiary? So we are going to look at the share capital, we are going to look at the reserves, the share premium, the retained earning, the evaluation. Then we are going to look at the reporting date. So any changes which is considered to be the post-acquisition changes, any changes which is considered to be the post-acquisition changes should be taken into account, because when we are going to do further distribution on the retained earning as well as the NCI based on the method that we are going to use, we are going to share this post-acquisition profit between the parent or the NCI. We are going to look at it separately. Don't worry about it. So for now, what you need to know this formula that we are going to take the working capital at acquisition date. So the share capital at acquisition date and at reporting date, the reserves, the share premium, retained earning, and evolution surplus at the acquisition date and at the reporting date. This is what we are going to do for working two. Then also very important note, working two shows the value of net assets at various points in time. Already explained that one. And then nothing to worry about. If the post-acquisition evaluation surplus, very important point, you need to note this down. If the post-acquisition evaluation surplus, we are talking about post-acquisition for only evaluation surplus, the group share of the post-acquisition evaluation surplus will be part of the group evaluation surplus, not taken to the retained earning. Now, very important point. In a situation where we have for evaluation surplus, the one at the acquisition date is not the same as the reporting date. Let's assume this figure, the one at the reporting date, for the post acquisition, one at the reporting date is 5, for example, and the reporting date is 7. So there's a post um, evaluation reserve of 2. So now this evaluation reserve, when we are going to do the distribution, we are not going to take it to the retained earning. Look at the concept. We are not going to take it to the retained earning. Instead, we are going to look at the group evaluation surplus. That's how we are going to account for this particular tool. But don't worry, when we are going to solve question, you can able to see the movement of the figures. For now, you just need to know your template and know which figure are you going to use on your steps. Step 3, we are going to look at the calculation of goodwill. Very important concept, how to calculate a goodwill. So basically, the calculation of goodwill, we can look at the cost of investment in the subsidiary is what we are going to take. Because the essence of goodwill is telling us, I explained it a few minutes ago, we want to know how many excess do we pay to acquire or to secure the interest in the subsidiary. Because by default, based on the operational activities of the subsidiary, in any way round, the subsidiary might have developed some goodwill, some form of reputation, some form of customer loyalty, some form of best business practice that will provide substantial benefit for the group structure as a whole. So that amount, that internally generated brand, that goodwill, that good reputation, that good customer service, that good customer base or customer loyalty, we need as a company. If we are going to consolidate it, we need to pay extra so that we can secure short benefit from the subsidiary. So that extra that we are going to pay is what we refer to as the goodwill. So now this is the formula. We are going to look at the parent holding, the investment at fair value. We are going to look at the non-controlling interest at acquisition. And also, we are going to less the fair value of net assets from working two as acquisition. Then we are going to get goodwill at acquisition. Then, if any impairment, it's obviously, if any impairment given in the question, we need to deduct the impairment. Then the difference will be the goodwill that we are going to show in the statement of financial position. Very important. Now, what again you need to know the non-controlling interest, there's an asterisk on it. You need to know the formula. We can include the non-controlling interest, and also we can't include the non-controlling interest. Now, what I'm saying, if we are going to use the fair value model, if we are going to use the fair value model, this model, if we're going to use the fair value model, right? If we are going to use the fair value model, this model, the NCI equals to the fair value of the NCI holding and acquisition. That is, we are going to take the number of shares owned, NIC, multiplied by the share price of the subsidiary. Don't worry, we're going to look at it separately. But if we are going to use the proportionate net asset method, then the NCI equals to the NCI multiplied by the fair value of the net asset at acquisition. Simple from working two. Don't worry about it. We're going to look at it separately. Now, you need to worry about how we can account for the goodwill. If there's a positive goodwill, in other words, if the cost of investment is greater than the net assets of the subsidiary, then we are going to consider it as a positive goodwill, which we are going to show as a non-current asset on the statement of financial position. But if the cost of investment is it's less than the net asset, then we're going to look at it as a negative goodwill, which we can consider as a bargain purchase. And we are not going to show it under the non-current asset. Instead, we are going to show it under the retained earning under working five. Very important point and very important concept you need to know. So these are the formula you need to know, the steps you need to know. Then working for the calculation of the non-controlling interest. Basically, for the NCI, in other words, the share of the subsidiary in the group structure is what we refer to as the NCI. So the NCI, we are going to look at the NCI value at acquisition, which we have calculated from working three. Then we are going to look at the share of the post-acquisition reserve I mentioned earlier. The post-acquisition reserve, for example, if there is a change between the from working two, there's a change between the acquisition date of the net asset of the subsidiary and the reporting date, that changes, the NCI proportion should be accounted for. Share NCI, for example, if the NCI is 20%, then 20% of the post-acquisition profit should be included in the non-controlling interest. Also for impairment, very important concept. Now, let's understand the treatment of impairment under the goodwill. Now, if we are using the fair value method, then the impairment, we are going to share it between the parent and the subsidiary. Fair value method, it means impairment will be shared between the P and subsidiary based on the group, the ownership, the percentage percentage holding. Simple concept. But if we are going to use the proportionate method instead of the fair value, then therefore we are not going to share the impairment between the parent and the subsidiary. Instead, we are going to account for it under the only for the parent. So impairment will be taken to the parent. That is the retained earning. The retained earning. Simple concept you need to know. So if we are going to use the fair value model, therefore the NCI, the impairment, we are going to share it between the parent and the subsidiary. But if we are not going to use the fair value model, instead we are going to use the proportionate model, then it means that impairment, we are not going to share it. We are going to take it directly to the retained earning. So now, the double entry will be like this for impairment. It's obviously that we are going to credit because the goodwill, we are going to reduce the value of the goodwill. That's impairment. So, for example, we are going to credit goodwill for the impairment, right? Goodwill. Now, sorry, let's assume we are going to use the fair value model. The fair value model. Hmm? We are going to debit the NCI and we are going to debit the retained earning. Credit goodwill, debit NCI, and debit retained earning to account for the impairment. But if we are going to use um, the proportionate method, the proportionate method, then it means we are going to credit the goodwill, whilst we are going to debit the retained earning. Nothing, we are not going to take anything to the NCI. So very important point you need to know, and it is very technical for the exam. Working five, the parent, the retained earning, the group retained earning, which is working five. So basically, we are going to take the retained earning of the parent 100%, then any post-acquisition retained earning from working two, we are going to account for it. Then impairment, we are going to less it. Whether we are going to use proportionate method or whether we are going to use the fair value model, we are going to account for impairment. If we are going to use proportionate method, then we are going to account for the impairment 100%. Whilst if you are going to use the fair value model, then we are going to account for the impairment on the percentage ownership, the ownership percentage. Then therefore we are going to account for any bargain in the situation where there is no goodwill, or whether the goodwill, the cost of investment is less than the net assets, then it is a bargain purchase. So we are going to account for it under the retained earning. Whilst if the cost of investment is more than the net assets, then we are going to take it under the goodwill and the non-current assets on the consolidated financial statements. So basically, um, this is the steps. These are the steps that we need to know for the preparation of the consolidated financial statements for the examination. Note, if the parent has two subsidiaries, if the parent has two subsidiaries, then it means separate working for working two, because we need to calculate the net asset of each subsidiary, goodwill, and also working for. We need a separate working to ensure that we account for all of the various subsidiaries. So basically, this is the concept of consolidation and looking at the steps as well. So nothing to worry about. And all of this we have explained the basic concept. Also for a goodwill, the proportionate method as well as the fair value model. Now let's browse through the goodwill so we can able to understand better. We are less than 100% of the subsidiary is acquired. It is clear. The value of the subsidiary compares to two elements. We are going to compare the value of acquisition of the parent and the value of the non-controlling interest, which is clear. What exactly the goodwill is telling us? If the company acquired 70% of the subsidiary, it means when we are going to calculate our goodwill, we need to calculate the cost of investment of the 70% and the investment remain of the 30%, which is not the the owned by the parent, but by the NCI, the non-controlling interest. Then also we are going to compare it with the net asset of the subsidiary. But however, there are two methods by which the goodwill will be calculated. This is what I'm talking about. We have the fair value model and we have the proportionate model. So if we are going to use the fair value model, when we are going to use the fair value model for the impairment, we are going to share it between the NCI and the parent for the impairment. But also other area that we need to know that is very much important for the exam. Now, the proportionate of net asset method calculate the value of goodwill attributed to parents only. Very important point to note. Very important point to note. Only. Only. If we are going to use the proportionate method, that's why I told you that when we are going to calculate the goodwill, in some cases we should not include the NCI. Some cases we are going to include the NCI. Now, if we are going to use the proportionate of net asset method to calculate the goodwill, it means we are going to attribute the goodwill to only the parent. Whilst the fair value method calculates goodwill attributable to both parents and the NCI. You need to note it down. We have already covered the treatment of goodwill. We are going to show it as for positive goodwill, where the cost of investment is more than the net asset, then we are going to show it as tangible non-current asset. We are going to test it for impairment based on the condition as per IAS 36. So don't worry about it. And impairment, as I explained a few minutes ago, if we are going to use the proportionate method, we are going to debit the group reserve. In other words, then we are going to credit the good. We are going to reduce the goodwill. Then we are going to debit, which is a reduction as well from the retained earning. If we are going to use the proportionate method, if we are going to use the fair value method, we need to share the impairment between the reserve and the NCI, and we are going to credit goodwill. Nothing to worry about it. I've already explained it in detail. So now for a negative goodwill, you don't need to worry. We are going to account for it as a bargain purchase, and we are going to treat it under IFRS 10 as well as IFRS 10, the business combination. So basically, for today's session, let's try to master the formula, the various steps, so we can be on the safer side. Then in our next session, we are going to look at how to account for the pre and the post acquisition reserve, which is very much important for your understanding, and it is considered to be one of the most technical parts of the consolidation. So thank you very much for your time.